Good afternoon, everyone, and welcome to the first Affirmative Coffee Talk. I hope you all got a warm cup of coffee on this freezing cold day and are as excited as we are to hear more about higher risk originators and how to benefit from those as an FI if you are allowed and able to accept them. With me today are Claudia and Kim, who combined bring to our coffee table more than 60 years of ACH and payments experience. Hard to believe. Claudia used to work with Midland Bank and Trust many years ago and is now vice president at Valley Bank. And Kim used to work for Wells Fargo and Space Coast Credit Union and is now for 4 years with us at Affirmative, where she oversees the customer onboarding and is a driver for innovation as our vice president of product. Anything to add? Anything I forgot? Kim, Claudia?
Nope.
Thank you so much for joining and our first coffee talk today. As you know, our topic today is like how to benefit from like higher risk originators and how to make sure that you can manage them somehow safely. Elizabeth, if you wouldn't mind pulling up the first slide, first question we have, like why are the why are the riskiest looking originators often the most profitable ones? Maybe to Claudia. I know you are doing quite a lot with like perceived higher risk originators. Like, what would you say is the reason behind why they are more profitable than your average ACH originator?
Well, for first, you have, once you look at the whole relationship and you decide if they're doing high risk and they're going to be needing more oversight, you're going to have to make up the funds you're going to spend on all the overall AML/BSA action you're going to have. You're going to have a more you have to monitor them more when it comes to transaction monitoring, what is flowing through, what's their ratios, returns. So you could always tack on, you charge a normal originator, 10 cents an item or whatever. If they're doing same day, you charge them a little extra. On this, you could charge them more than what you would normally charge a normal originator.
And it sounds like there is a bit less competition compared to like the standard low risk originator, right?
Right. Well, you have your payrolls where you're worried more about, someone changing their account number and having it go to the wrong place, which because there's always risk in ACH, right? No matter what you do, it could be a BIC, it could be any of that. But when it comes to people like cannabis or gambling or any of those things that we might be doing or other banks might be doing, that's where you really have to look at it and say, all right, this is normal, but I'm going to have to hire 2 people to do additional compliance checks on them, and then you should be charging a premium. It's like when same day first came out, everybody kept saying charge them a premium is something new. Well, now it's normal, so you need to do, if you're doing high risk and same day, charge them a premium if you're doing it.
Kim, I know you worked at the credit union here in Florida for many years. How was their approach to perceived higher risk verticals?
So we were pretty risk adverse, and that's one thing, as I work with financial institutions on a daily basis, I see risk adverse financial institutions, all over the place, and that's pretty normal. But there are financial institutions like Claudia's FI out there that isn't necessarily as risk adverse. And I'll say this: when you're looking at getting into the high risk originations, when you're looking at onboarding them, yes, there's due diligence that you have to do. Yes, there's additional regulations that you have to do, especially if you're in that cannabis or that gambling or money service businesses, those sorts of things. But when you start to onboard those, and if you have that proper oversight and you treat those originators good, they'll stay with you. And that's going to help for customer or member longevity. That's also going to give you the ability to continue to grow your business. And if you get into that cannabis banking, right? And of course, you've got to have board approval. There's red tape that you got to go through, but you get the buy-in. You start bringing those folks on board. To Claudia's point, right? You can charge them more, right? They're going to be willing to pay more because not everybody is going to bank them. And that's going to create, additional loyal customer base, and it's going to give you that additional growth opportunity in that higher risk avenue.
Yeah,
and I think
especially,
some of them. Oh,
I'm
please go
sorry,
ahead.
especially, yeah, and to Kim's point, I mean, what bank isn't risk averse, right? And the more you have where it comes to the total assets of the bank, it seems sometimes that risk aversion, where you think it would be getting larger, just starts to shrink, right? So it's important to make sure that the oversight is where it is, that the reporting is where it should be. That's I think just I totally agree with what she said there.
And especially the volumes for like the money services businesses, Kim, you mentioned earlier, those are sometimes very high, so quite attractive for fee income, right?
Yeah, absolutely. And when we actually look at the industry and look at the amount of the high risk originators and kind of, who they are and what percentage of the overall origination market that they make up, it's actually a very small percentage when you think about it and you look at all of the other originators out there. So, in the market, I think like it makes up high risk originators, I think they make up about 2% of the population of originators at risk of originating an unauthorized ACH. So it's a very relatively small percentage when you look at like the overall like originators out there, in the industry. So they could still be considered high risk, maybe in potential like other areas. But when you're looking at, that unauthorized ACH activity, which is of course the hot topic right now, especially around the not to 2026 rule changes and all coming up, it's a very small percentage.
Hmm.
Yeah,
And you
I
still,
agree to that though. Let me just say one thing that Kim's totally right. Like it's the volume, right? So if you have an originator that's going to pump out like 10 million, I mean not 10 million, how about like 10,000 items a day over the course of a week, and they're relatively low risk when it comes to it's a B2B. It's they can prove they give you their proof of authorizations. They show you the contracts. You've done your due diligence, specifically with TPSs, right? You have to remember they're third party senders. People don't want to bank them either because you don't know who they're banking, right? And then you have all that underneath it. So the more volume they pump out, the riskier it is. So that's where you also have to watch it, and you can judge by volume, and you get those return ratios. You see, they send out 10,000, and they only get 5 back unauthorized. I mean, like that's beauty in the ACH world.
Absolutely.
Yeah.
But Kim, you still couldn't bank them, right? Like those kind of verticals were a no-go for you back at the credit
Absolutely.
union?
Yeah. And, kind of like we talked about a little bit earlier, there's just a lot of red tape when you're looking at bringing on, whether it's cannabis banking, the folks in the gambling industry, those money service businesses, because not only do you have maybe federal regulations that you've got to go by, but you've also got state regulations. And I think, Claudia, I think in even some of our previous conversations, you had brought that up, that it varies by state, and you've really got to be in tune to that, because that can make a big difference of, the decisions you're making.
Right. And are they selling cannabis versus medical marijuana versus CBD versus, just vaping? It's like it's depending on what you're selling, depends on what you can do. And do you want to bank those? Do you bank those? It's that's completely true. And what state? Washington versus California versus New York versus New Jersey versus anybody who's made it legal to smoke cannabis. Like that's something you have to worry about. And to get into the industry, it's selling it to your board, right? Because at first we weren't doing ACH transactions. It was just saying that we were going to help the cannabis industry, and we're going to banking deposits for specific cannabis retailers or sellers or any of that stuff. So you have to, where are they growing? Are they growing in a state that you're doing business with? Like it's across the board. So, I mean, just that alone is where people start going, I don't want it. It's just so much. It's so.
And it sounded like Kim earlier when you said like 2% only are like the black sheep that you should monitor a bit more closely, those high risk originators. And Claudia, you must have like an ACH crystal ball out there and be able to predict like which transactions come back as unauthorized if Like
I
otherwise,
do have a crystal ball now, but
you
it's now the
do.
predictive. It's the predictiveness of what Affirmative's been giving me when it comes to what might and might not come back due to the new reports that they have out there for the 2026 rules that are coming in March. They actually have something that will look and say, we think this is going to come back based on what we know. And I've been checking them, and they've been right with some of them. So, which is good, because then I can really monitor what's going on and how it's going to work, and do I need to worry, and can I reach out prior to it happening, saying we need to stop it in the future from moving forward.
You mentioned this is like part of the NACHA 2026 rule change, but it sounded like you're not just using it because you need to in like 2 months or 6 months, 5 months, depending on like your FI's size, but you're using it to your advantage, and not just to be compliant, but here to potentially grow your revenue and accept perceived higher risk
Right,
originators.
because I mean, again, you said 60 years between the two of us, 40 of those were mine. And so I remember being back in the day where you were using green and white bar computer paper that was this big, and you were using a pencil and a pen and a ledger, and you're doing these things, and ACH was around, but it wasn't, since 1974, but it wasn't like proficient, and I wasn't in banking in 1974, and it was very proficient, like hard to, it was happening, but you had to do everything on paper, and now to have the ability to go in and just pull data out and look at it and review it and analyze it, see what's going on. Yeah, not just for 26, it's something that everybody needs to do now. And to be able to rely on it to make sure it's correct, that you can pull it and it's right. That's important.
Kim, what kind of tools did you have when you were not allowed to use um, that kind of like business when you were not allowed to go in there and like basically make more money for the credit union? Like, were you still on that
Excel.
like piece of paper Claudia described?
It would Excel, right? And I mean, that's still so common in the industry today, is you're using and tracking return rates through Excel. You're monitoring your NOCs and those repeat offenders through, Excel. Um, that's where you're keeping your originator risk scores. Like, everything is just in this master Excel sheet. And, heaven forbid somebody gets in there and don't know what they're doing, or they, transpose numbers, right? Like, that data is used and is compiled and eventually filters up to the board. And that's a really scary thing when you're in such a manual world in this day and age, especially. And you have to worry about bad data, right? Because of human error. And we're all human, right? We're all going to make an error at some point. Nobody's perfect. But, it's so scary out there that, we still have to rely on such manual processes, and they're so time consuming. And when you're looking at growing your originator program, when you're looking at potentially bringing on or exploring the world of high risk originators, you really got to get out of that manual piece, and you've got to get automation in place, because that right there is what's going to help you grow. It's going to help keep you compliant. If if you've got somebody out there plugging away on an Excel spreadsheet, that's not effective time management for anybody. That person that you've got doing those Excel spreadsheets, they could be utilized in a much better form or fashion, with actual like oversight of the risk management, instead of just daily data input and hoping and praying that it's right at the end of the day, end of the month.
And what would change when risk becomes something you can see and measure and manage instead of assume? Like, I guess back then it was like quite unknown, everything, bit scary, as you said, as the unknown is always scary. Like, what would have been different if you had like tools in place?
Yeah, so there's fear of the unknown, right? When you don't have good, clear visibility on what's happening in your origination program, that right there continues to promote being risk adverse. That's the word I'm looking for. And when you have the tools, the processes, the automation in place, that's going to allow you, your financial institution, to grow and to do more for your originators, because the more originators that you bring on, the more oversight you have to have, and you want to keep them with your financial institution. But if you're not treating them right, who's to say that they're going to stay, right? You need to be looking out for their return rates. You need to be having those conversations if they're getting, close to their return rate limits, or if they're having, they're repeat offenders for NOCs, or, they've got crazy volume fluctuations and variances, right? It's up to you and your team to actively and really proactively manage to that stuff. So I think like my kind of summing it up, like my answer to that question is, once you can see it, you can see that risk, you can analyze it, you're getting out of that manual piece, and it's giving you the ability to be proactive versus reactive and the ability to grow.
Hmm. And data doesn't lie, right, Claudia?
Oh, data does not lie.
Data does not lie. No, and the nicest thing is that if for a very long time, people, you always work on different systems, no matter where, if you come into a new bank from a merger or somewhere else, and you've always trusted what you used to have. You don't truly trust what you do have. And then you have to try to figure out how to make the two speak in your own head. So you're going, this is great. I have the data. And now that you go back and you double check it. Which is it's another waste of time in your life where you're never going to get back, right? So if you can present to somebody going, this is correct, I know it's correct, this is what it said, their exposure, I don't know why you gave them $50 million. They need to be 10. They're only doing payroll, and it's no more than if 8,000 going out at a time. I don't know why you did this so much. Or they're having uber amounts. They're so over their return ratio that we've got to stop them from even originating before not just slams us with something. It's all of that, and so if you can present it, and presenting it to your immediate manager, their manager, and just going up the ladder of who you have to report it to when it does get to the board, that is also in a way that they don't want to read something that you wrote. They're not going to read a thesis statement, right? They're going to want a nice dashboard that's got a graph on it that shows them do spike. That's all that matters, right? Here's their deposits now. They're spiking, but on the other side, our returns are spiking. This wasn't a good idea. Let's try to bring it down. All of that's important.
And to your point, Claudia, it needs to be simplified. Yes, it needs to be a graph. It needs to be, it doesn't need to be a thesis. First of all, they're probably not going to understand, if you give them a thesis, what it's even talking about, right? Because if you think about it, the majority of the folks that are sitting on these boards, and I'm not discrediting, their capabilities at all, but they may not be payment nerds like us, right? They may be doctors, they may be lawyers, they may be, folks that have been in the financial industry but are on the, loan side of the house or whatever. So the easier that you can paint that picture, for them, right, and show them, one, where the opportunity is, and two, like where the risk is, that's going to help them make those better informed decisions and potentially be less risk averse.
Is it at all like a risk topic? Is it like payments, or is it like risk perception, the problem? Like, what would you say is like the real problem here around these like perceived higher risk originators?
It may not even be that, higher risk originators are one thing. You put all those in a bucket, and it depends on what your view of higher risk is. For any bank, a higher risk might be that they're doing web or tel payments, right? And then you have all those other issues of are they reviewing their micro deposits? Are they making sure that they aren't, are they doing the validation of the account owner? Are they doing all that? Or they might be a PPD where they're worried that they're sending out all these PPDs, and it's like all of a sudden they do this one big file that's like doesn't make any sense to you. Or it could be gambling, gaming, cannabis, any of those. It depends on what your version of high risk is,
Hmm.
right? So it's not necessarily the business they're in. It could really just be we don't want to deal with that standard entry class code, like telephone transactions. Like that's a whole world in itself. So those are the kind of things you have to decide what's high risk and how you're going to handle them. And then again, having the ability to see the data, and then also, the regulatory part and all that, that's like mandated. You have to have that. You've got to have a good reg compliance department. You have to have an AML department that's good. And we're very lucky we have a good one here, right? You need to have people in your department that know what they're doing. They understand the rules. You have to have trust in all that too to make this, worth the time of you taking these clients on and then setting the originator out. Because you know what? If you're going to send garbage out, you're going to get garbage in, and it's going to destroy your financial. The last thing any bank wants to have. Risks are acceptable, but a reputational risk is not something you want to have happen.
And what would you say is like the benefit? Like what becomes possible, to our last question as we are heading into like the last 10 minutes of today's coffee talk? What becomes possible when financial institutions like Valley can confidently say yes more often and not rule out some verticals completely?
I think if you do it right, if you're making sure that you're presenting the data right appropriately, if you're making good use of what you're seeing, you can see that it's over, but you also have to be able to act on how are you going to act, having the proper policies and procedures in place within the department as well throughout the bank, and trying to share the understanding of ACH, because it's not just for items coming in and out, right? ACH doesn't come in and just doesn't come out. So there's many things in between. And first, you got to know, you got to have the right people, the right people, the right tools, and the faith in what you're getting. That's what you need.
Amazing, thank you. And Kim, going back a few minutes, what you mentioned with like the technology piece. How do you feel about like more traditional, more conservative FIs, like for example, the credit unions? What if they also had those kind of tools? What if they also could predict with quite a high accuracy who would be returned as unauthorized? Like, how would this help there?
Yeah, I mean, I think it's going to help them grow their business in general. So even if they are kind of wanting to steer away from high risk originators, right, it's still going to give them tools, resources, and the knowledge to really make informed decisions about the originators that they've brought on board, how to continue to handle them and their relationship, because it's also really important with that continuous monitoring. Somebody can go from a low risk originator to a medium risk to a high risk originator, just depending on what their situation is, right? So in the industry, we see it happen where an originator will go from like a medium risk to a high risk originator like category. But when you're conducting those originator reviews and you're doing those like on an annual basis, that's a whole year that you're waiting in between, like to do those originator reviews. A lot can change with an originator during that time. And if you've got, let's just say 50 originators, that is way easier to have eyes and ears on from a more manual level, right? And conducting those originator reviews versus when you have hundreds, if not thousands of originators, how do you effectively monitor to those? How do you effectively conduct those originator reviews? That's when like your strategic planning and how you strategically manage those originators moving forward really comes into play, because there is absolutely positively no way that anyone is going to get all of their originator reviews done if they have hundreds and thousands of originators and getting those all done within a year. So if you can, one, predict those high risk originators, which ones are going to have those unauthorized ACH transactions, then you can prioritize those reviews. And then you can say, all right, I've got 50%, 60%, whatever of my portfolio falls into that lower risk category. Well, great. I have some sort of automated monitoring out here, right? We've moved away from those spreadsheets. We've got automated reporting on our return rates. So I've got visibility, but I don't have to conduct their annual reviews on an annual basis now. I can move it out to 18 months or kind of whatever you choose. You don't want to push it out too far, of course. So you want to have good judgment on that piece. But you can turn around and focus your efforts on the high risk originators and focus on if you need to, you know, change their exposure limits, right? Do you have their limits set too high? Are you creating too much risk exposure? So you've got just a better way to prioritize and really just understand what's going on with your originator program. And that's done through technology, right? It's good through good data, it's good through technology, and it's good through automation. And that right there is a big game changer for a lot of folks when they can get that stuff in place.
Amazing closing words. Thank you so much for all those insights. For everyone on the call who wants to learn a bit more about Affirmative, about this ACH crystal ball that Claudia is using so successfully here, we are more than happy to jump on a quick call and talk more. You see on the left the QR codes to our calendar, so feel free to scan this one or send me an email, and we are happy to jump on a call with you. Or on the right side, we are at NACHA in San Diego in a few months, and we have a special giveaway here. So if you scan this QR code on your right side, you can win a nice trip on a catamaran in the bay on Tuesday evening. So and feel free to do both. So I hope we will talk to each other soon, either in a virtual meeting or at NACHA. And good luck with signing up for this NACHA raffle, and good luck to you, and enjoy the rest of your day. And thanks so much for joining us today.
Thanks all.
Thank you.
Bye.
Bye-bye.